What do you think investors will focus their attention on and why during the next few months? A shares or H shares?
Well, certainly there's a lot of attention on the Chinese equities markets in light of the change of administration in China and the focus on more of a reformist, purposeful government, and as part of that, liberalizing the markets. So the effect of that on both the A and H share markets we think will persist. As a point of background, A share market represents the domestic listed Chinese equities, and the H share, the Hong Kong listed Chinese equities market. The challenge is that Hong Kong shares are quite readily available and investable by foreign investors like ourselves and yourselves. The challenge is in the A share market, it has been on a more restrictive basis through what's called the QFII, Qualified Foreign Institutional Investor Program. So essentially the capacity for foreign investors to go into the A share market has been quite limited. That has changed as the CSRC has opened up their arms to more foreign investors, and the reason for that is they would like to see a more sustainable, long-term investor base investing in the A share market. Maybe two data points to give you a bit of background on A and H shares. Currently, we see both markets being quite cheap relative to the historical averages. So the CSI 300 future index is representative of the domestic equities, and that's trading at about 9 to 10 times forward 12-month PE versus historical average of 18 times. MSCI China equities market is trading at about 10 times relative to historical average of about 13 to 14. So if you look at that and you couple it with the earnings growth expectations across both markets, we expect double-digit growth. We see those markets being quite cheap and compelling. So for those reasons, we see a good opportunity set across the two, albeit on the A share side, a little bit limited given the QFII issuance constraints.
Most asset managers think that the Chinese market lacks transparency. What do you think about?
So the lack of transparency in the Chinese equities market is not a new phenomenon and not a new concern. I think what is a new development is the government's focus on cracking down on that lack of transparency and cracking down on insider trading. Chairman Gao, as part of CSRC, that's been part of his emphasis on instilling confidence and credibility to the markets. Why is that important? For many of the investing public or the individual investors in China, the markets and real estate are two of the main ways you make money. So in putting more credibility into that market will hopefully foster future sustainable growth domestically, but also encourage more foreign investors to get attracted to that market.
Are you worried about the stability of the Chinese banking sector?
So the Chinese banking sector has had a lot of noise around it, and it's not a new phenomenon. It's one we've consistently heard over the years. A few things to highlight. One is the 4 largest banks are state-owned banks, so government-controlled. And as part of that, the banking system in many ways is too large to fail, and one that the government essentially won't allow to fail. What's probably more important is focusing on where we see some reforms in the banking sector. Specifically in this new administration, there is an emphasis on the liberalization of interest rates. So as part of that, we see more credibility and opportunity in the banking sector.
The Chinese monetary policy has been very flexible and it allowed the country to overcome the frightening hard landing. Which steps will follow according to you? Which will the future of the renminbi be during the next few months?
So with regard to the renminbi, we don't expect material appreciation, so big moves in the near term. We do see a gradual appreciation. So if you look at the last, since 2005, the renminbi has appreciated over 30%. And in that same time frame, GDP growth has been over 120%, so it's actually expanded. If you contrast that with US GDP growth, that's been around 11%. So there certainly is an upside there, but the challenge is doing that in a methodical and gradual way rather than doing it in a large order of magnitude way.
Which are the golden rules to invest in China?
So some golden rules include, one, making sure you're investing with a team that's on the ground, on the mainland, understanding the local culture and understanding how to properly value domestic companies in China. The reason for that is there's tremendous dispersion across sector and intra-sector in China. And being able to cull through the winners and losers and understand how, let's say, macro policies will affect forecasting assumptions for companies within a sector is important. So that's one element. The second golden rule to China is don't necessarily shy away from the volatility in the markets. So our team, for example, likes to see the market going to extremes. One of the main reasons for that is it enables us to potentially scale up positions when others are selling and therefore bring our average cost down. So can present really good, potentially good entry points for us and good safety margins. But at the end of the day, understanding that the Chinese markets can be incredibly volatile. It reached over 70% intraday volatility in 2009. Again, it's important to have a team on the ground who comes from the China equity markets. Our team, for example, cut their teeth in the A-share market, unlike maybe some of our peers who cut their teeth in the Hong Kong market and only now are focusing attention to the A-share market. That's what I do believe will ultimately help identify alpha opportunities for investors. And I guess last but not least, there's a large phenomenon occurring right now, which is the MSCI indices historically have had very low weight to the China markets, and also in some indices zero weight to the A-share, China A-share space. As that market continues to liberalize and more foreign entrants come to the market, so we're seeing maybe QFI representing something like 6, 7, close to 10%, which we expect to happen in our lifetime. When that happens, the MSCI indices are going to have to recalibrate and reconstitute to have a larger share of the pie go towards China. And as that market again becomes more investable and it becomes more relevant to international portfolios. Why is this important to the investing public out there, especially in Italy? China historically has not necessarily been a core allocation, and there certainly is a case for that to happen in the future. And being ahead of the curve before ETFs and the passive index-linked money follows that reconstitution is a good place to be. You want to be there before the rest of the market hits that space. So we do believe having a core allocation to China now is going to happen sooner rather than later. Doing it now where opportunity is cheap on a relative basis is a good time.